Hello, I'm Gaurav Sharma. I'm an independent oil market analyst and a contributor to Forbes, Rig Zone, and various other publications. Today we are here to discuss the oil market at unprecedented time when the coronavirus has taken hold and has led to a more or less near-term collapse in oil demand. What we have right now is not just a collapse in oil demand, but also a collapse in sort of consumer confidence. We're traveling less, we're going out. And in step with that, following the collapse of OPEC Plus on the 6th of March, what we have here is that a number of producers are putting a whole lot more oil on the market. So if you have the first chart, that just about tells you the benchmark prices that we've had since the start of the year to where we stand now. And they're more than halved if you use Brent and West Texas as a benchmark, as a chart conveys to you. And that is not just down to the coronavirus. What has happened is that when OPEC Plus collapsed on 6th of March, 10 Russian-led non-OPEC producers and 14 members of OPEC decided they will open up the taps. So what we have is an unprecedented situation. If you rewind the clock back to the global financial crisis, you had a demand crisis. If you roll the clock back to 2015, 2016, when a lot of American oil was coming on the market, you had a supply crisis. As we stand in March 2020, with the coronavirus, we have demand depression, and with the collapse of OPEC Plus, we have copious amounts of barrels coming onto the market. Now, if you have the second chart with the OPEC prices, that tells you the negative impact. We still haven't hit rock bottom, the kind of prices that we've seen during the supply glut of 2015, 2016 in terms of OPEC averages or the financial crisis. But chances are we are getting there. And now if you could revert back to the first chart, if you look at the benchmark prices and we use these as a base case scenario, I think there is a chance that oil could hit 20 or even sort of the late teens, so the 18 or 19 dollars per barrel, using Brent as a benchmark, because what we are facing right now is a simultaneous supply and demand crisis. Well, where from here? That's the key question. And that lies in what kind of macroeconomic data comes out and what we get from the macroeconomic data. For instance, the PMI data. For instance, the impact on our travel patterns, on our shopping patterns. And that will determine the course from here. The second clear point here is how soon, or for that matter, how late does the world get a handle on the coronavirus crisis? Now, I'm not a medical expert, but this thing peaks and then declines real fast. So if you look at China as an example, it all blew up around the 25th or 26th of January. Then sort of China has worst days around about the middle of February. And now and there's a big caveat, if you rely on Chinese data, it's calming down. But Europe has flared up. So it's early days. But right now, from where we sit, I think oil demand is going to be substantially low. Some people are predicting as much as a shrinkage of 155,000 barrels. But that to be the case, it is highly unlikely that Brent would average more than $40 a barrel, even if we have a sort of a recovery around about the third quarter or the fourth quarter of the year. So, and if the OPEC entrenchment continues, there'll still be more barrels than the world needs. Now, my theory is that once the oil price hits sort of the late teens, the lower 20s, I suspect Russia and Saudi Arabia, who are causing a lot more barrels to come onto the market, would get back to the negotiating table fairly swiftly. The Russians need about $40 to balance the budgets. The Saudis need about twice that. But at the end of the day, it's in neither's interest to keep oil prices where they are. Having said so, I do attach a caveat. The way the coronavirus panned out, events might have overtaken OPEC. So we can look at depressed oil prices for a long period of time, at least for the next 3 to 4 quarters. Thank you for listening.